The evolution of usury and the birth of the Bank of England. 1. Offa's silver and the prohibition of usury. In the 8th century, King Offa of Mercia introduced England's first structured monetary system. Gold was scarce, so silver became the medium of exchange. A pound of silver equaled 240 pennies, and the coin bore a star, from which the word sterling originates. Offa also outlawed usury in 787, setting a moral and legal precedent against interest. Successive monarchs, including Alfred and Edward the Confessor, reinforced these prohibitions, going so far as to declare usurers outlaws. This was an early English attempt at financial justice, albeit with a touch of medieval severity. Footnote: England's first coinage was silver-based, and laws against usury were embedded in both royal and religious authority. 2. The arrival of moneylending and expulsion. The Norman conquest of 1066 brought not only new rulers but also Jewish financiers from Rouen. Allowed to practice usury under royal protection, they imposed rates as high as 300% on tradesmen. Within 2 generations, a quarter of English land had shifted into their hands. By the 13th century, resentment was widespread. The Magna Carta of 1215 explicitly sought to cancel Jewish bonds and end their financial privileges. Edward I, recognizing the destabilizing effects, expelled the Jewish population in 1290. Unlike modern expulsions, they were allowed to take movable goods, though any who lingered risked execution. Footnote: The expulsion of 1290 was a direct response to usury and land concentration through debt. 3. The Golden Age of tally sticks. With moneylenders gone, England relied on tally sticks, wooden notched instruments that function as interest-free government credit. Tallies financed salaries, infrastructure, and even cathedrals. Taxes were light, the state held no debt, and workers enjoyed high purchasing power. Records suggest a laborer in the 15th century worked about 14 weeks a year with over 160 holidays, proving that leisure was not invented by modern unions. Prosperity flourished until later monarchs relaxed usury laws in the 16th century, gradually inviting debt back into governance. Footnote: Tally sticks enabled centuries of growth without debt or usury, providing a rare model of sustainable finance. 4. Cromwell, Civil War, and the return of usury. The 17th century saw renewed financial manipulation. Jewish financiers, long expelled, supported Oliver Cromwell's rise during the Civil War. In exchange for financial backing, they were quietly readmitted in 1656. Simultaneously, goldsmiths developed early fractional reserve banking, issuing receipts far beyond their actual holdings. Interest rates soared to 30% or more, while common laborers faced ruinous borrowing costs. England's economy shifted from freeholding peasants to debt-bound subjects, foreshadowing modern credit crises. Footnote: The Civil War facilitated the re-entry of financiers into England, embedding fractional banking and usury into national policy. 5. The Glorious Revolution and the Bank of England. William of Orange's 1688 accession, financed by Amsterdam bankers, led to the creation of the Bank of England in 1694. The bank was empowered to lend money to the Crown at 8% interest while issuing notes unbacked by gold. Critics argued this was legalized counterfeiting with compound interest attached. Within 2 years, paper circulation exceeded gold reserves by a factor of 50. Thus, Britain's national debt was born, an ingenious scheme ensuring perpetual repayment. Shakespeare, through John of Gaunt, had foreseen such bonds reducing England to a tenement or pelting farm. Footnote: The Bank of England institutionalized debt as a permanent condition of national finance. 6. War, debt, and perpetual servitude. From its founding, the Bank of England's business model thrived on war. Conflicts with France, the American colonies, and Napoleonic Europe were financed through escalating debt. By 1815, the national debt ballooned to £885 million, compounded by interest into billions by the 20th century. Politicians like William Cobbett recognized the scheme as a mortgage of the nation itself, creating starvation in the midst of abundance. Efforts at national banking failed, and secrecy shrouded the bank until 1833. By the World Wars, debt became the silent ally of conflict, with compounding interest the victor in every battle. Footnote: Britain's wars ensured exponential growth of the national debt, cementing usury as the backbone of empire. 7. Nationalization and illusion of reform. In 1946, the Labour government nationalised the Bank of England. Yet the system of fractional reserve banking, private influence, and secrecy remained intact. Later corporate maneuvers suggested possible reverse takeovers by private interests. Despite its name, the bank remains closer to an independent financial oligarchy than a public utility. The irony is sharp: England once banished usury to secure prosperity, only to end in a modern state where debt, interest, and opaque banking dictate national policy. Footnote: Nationalization of the bank in 1946 preserved, rather than dismantled, entrenched private control mechanisms.